Okay. Thanks for having me present my paper online. Although I hope I wish I can join you in person. And um, uh, so this is the title of the paper: How to Mutual Fund Response to the Pollution Events. And this is also a paper with Daniel and Jing from RMIT University and Oslan from Monash University. So we have seen a lot of papers and discussion and research on the climate change and carbon emissions, but there's still a lack of the focus onto the impact of toxic chemicals. And also, we saw many papers on the natural disasters, the consequence of natural disasters, but the human cost environment issues are still important to explore. So motivated by this, we tested the impact of the chemical pollution or chemical spills. So this can find so this is the chemical spill. So these are the human caused accidents that cause the release of toxic chemical into either the air or the water. So for example, I can give you one most frequently most frequent cost. Think of a constructor dig too deeply, and then they could damage the pipeline and then release the gas into the air. And another example can be that the train derail and then cause the damage of the container and release the liquid chemical into the water. So these are kind of human-related or human-caused accidents. And there are already some paper studied recently the impact of these chemical spills. For example, they studied the impact on firm green innovations and or environment risk perception, and also another paper studied the access to bank financing and firm sales and growth. But we take another look from the perspective of investors or the supplier of credit. And another evidence also suggests that, for example, this from a famous investor, that these chemical spills, big chemical spills, actually shape their strategy to invest into ESG firms. Right? So because of this and motivated of all of this, we study how do fund managers or how do mutual funds adjust their portfolio in response to the local news of the chemical spills. And we propose several hypotheses. The first is that how do funds do fund response to these chemical spills? And we argue that yes, after the chemical spills, funds tend to invest more into the high ESG stocks, so more into the green firms. And this could be out of several reasons. First, as the previous presentation from the Vivian as well, so the salient environmental events will draw attention from the investors. And another theory is just that it is more efficient for investors to dedicate funds to invest into ESG firms. So after the chemical spills, after hearing the news of the chemical spills, the fund managers will cater the needs of their clients, their investors, so they will invest into green stocks or firms. And also, after the increasing attention from the investors, the share price of the green firms will be pushed up. And this is opportunity for fund managers to invest based on their local news of the chemical spills to achieve higher or better fund performance by investing in the high ESG stocks. And there are also several reasons outside the risk return consideration. For example, fund managers may consider to enhance their social image and reputation by investing into the good firms. And also, after being aware of the hazards of the chemical spills, fund managers will care or have more concern on the daily life of themselves. So then this also motivates them to use their kind of power or strategy to invest in the green firms to make a good or better world. And they could be also biased to the sense of justice and feeling of doing something good. So this are the potential reasons that we hypothesize that supporting our hypothesis that funds will invest more into the high ESG firms after the chemical spills. And next, our question is that if they do respond, how do they respond? Right? So do funds invest or increase the existing the holdings of existing green firms, or do they buy new green firms? And we argue that because funds have tend to have a mandate or strategy to follow, and if they buy new stocks, this may not align with the preference or interest of the existing investors. So we argue that they could be more conservative to buy to increase the holdings of existing shares instead of buying new ones. And if they invest more into green firms, where the money comes from, and we argue that they could sell the brown firms and use that money to invest in the green firms, and we will test this. And lastly, we hypothesize that the fund's response will vary depending on the local environment and stakeholders. And we test by using two local variables. One is the political party affiliation, and the second one is the local belief of the environment issues, public belief. And brief on the data source and sample, we use the Thomson Reuters mutual funds holdings to gather the information about the mutual funds holdings on individual stocks, and then we merge the fund locations and other fund level characteristics from the CRISPR mutual funds, and we follow the standard literature. We exclude index funds and the funds with total net assets less than $15 million. And then because we focus on the equity investments, so we restrict our funds to have at least 70% in common stocks. And the merged data set covers 2000 to 2019. And the second database, because we need to identify the firms, whether the firm is a high ESG stock or low ESG stock. So we collect the firm ESG scores from the KLD database. And this database provides indicator variables, represent either the weakness or strength for several indicators. And we sum up all indicators to calculate the overall ESG score for each firm. And then because the ESG score are separated into 3 pillars, so we also separate them into environment, social, and governance pillar. And next, the next data source is from the U.S. Coast Guard's National Response Center. It records the reports of toxicochemical spills. This is each records represent a phone call from someone like that witness a chemical spill, and then they will call the agency and tell the detail. So it included the detailed information about one accident, which is the chemical spill, and we consider only the salient incidents, which result in at least 1,000 evacuations, which represents 99th percentile value during the sample period. And there are 63 events. And later we will use several filtering criteria to help to design empirical setting. So then the sample or the sample chemical spills will reduce to 36 events. And the last data is the local media coverage, and this is designed or defined by the DMA, which is designed market area. A DMA covers a set of counties that share the same TV and radio stations, or some could share the other media outlets like newspaper and internet. And this is the empirical setting. We want to compare the we want to test what happened after the after the chemical spills in terms of the funds ESG investments. But there could be some like financial events confounded with the chemical spills. So we use the DID regression, and also because the chemical spills happened or occurred in different time and in different locations, we adopt a stack DID regression. So basically, we compare the funds that are located within the same DMA as the event with those outside the local media coverage. So the treated funds will receive the local news of the chemical spills. And so for each event, which is the cohort, we include all observations, all fund level observations during the 4 quarters before and 4 quarters after the event. And we implement several restrictions to perform a clean comparison. First, we ask each fund to have at least one observation before and after the event, and control funds to have the same objective codes as the treated funds. And the control funds, we exclude all control funds that have ever experienced a chemical spill event during the sample period. So all the control funds now are the never treated control funds. Sorry. And so this is the regression. The dependent variable is several measures I will introduce in next slide. Several measures for the fund's high ESG investment. So remember that this is the fund level regression. And the dependent variable include the idea regressor, and the main coefficient of interest is beta 1. And we expect beta 1 to be positive because we expect that funds after the chemical spill will increase their holdings of high ESG stocks. And we to calculate the dependent variable, we first adjusted the firm's ESG score by minus the row score with the size adjusted, with the average score of their size decile to create or calculate the size adjusted ESG score. Then we create our first measure, which is the weighted average size adjusted score across all stocks in a fund portfolio. So this is represent the overall ESG performance of a fund portfolio. And then we calculate several kind of more direct measures. And the first one is the proportion of high ESG value, which is the total value of high ESG stocks divided by the total value of all stocks. And we define the high ESG stocks to be those whose size adjusted scores are larger or equal to the 15th percentile. And this is follow the previous literature. And we also calculate, because the value is equal to the shares times share price. Number of shares times share price. We do not want our result is driven by the movement in share price. So we also calculate the proportion of high ESG shares, and also the proportion of the proportion of high ESG stocks. So this is the number of high ESG stocks or high ESG firms divided by number of all firms in a fund portfolio. So let me skip this summary statistics. So basically, it shows that the portfolio score is a little bit right skewed. And so this here is our main result. So across all the specifications here, and the difference is the dependent variable. And for all the dependent variables, we find that the coefficient of interest is significantly positive. So to interpret that, this means that relative to the funds outside the media coverage, the overall ESG scores of the treated funds portfolio increased by 0.294, which represents 13% of the mean, and the proportion of the high ESG investments increased by 0.3 to 0.4 percentage points. And so this consistent with our hypothesis that funds respond positively by increasing their ESG holding, high ESG holdings. And because the variable is the the value or stocks, number of stocks of high stocks divided by the all stocks. So we separate the numerator and the denominator in the next regression. So here's the table, and in the first three columns, these are the levels of high ESG investments. So we find some result consistent with previous table, but we also find some shocking evidence. First, we find that both the total value of the high ESG stocks and the number of high ESG shares increase, but differently, the number of high ESG stocks does not increase. So this means that this indicates that the fund managers invest only into the existing high ESG stocks. They do not cherry picking the new green firms. Right? So this is also consistent with our expectation, because as I said before, the funds may have the mandate to follow. So they are conservative. And in the next three columns, which is where we use the denominator as the dependent variable, so we find that the total number of all stocks, total value of all stocks does not change after the chemical spills. So this has provides some indirect evidence that funds divest into the low ESG stocks. Right? So because they divest, they reduced the low ESG stocks and increase that into the money into the high ESG stocks, then the total value will not change. Okay, so then we directly test whether that's true by define the low ESG investment, which are the stocks that in the bottom group. So we find that all the coefficient, either the when we use the proportion, or we use the or when we use the levels of the high ESG investment, the coefficient are all significantly negative. Right? So this means that treated firms rebalance their portfolio by divesting from low ESG stocks and investing the money into the high ESG ones. And we find that even in the number of low ESG stocks, the coefficient is still significantly negative, which is different from the high ESG regression. Right? So this means that the funds are more aggressive in selling low ESG stocks than in purchasing high ESG stocks, new stocks. Right? So then we tested the dynamics of the treatment effect. We separated the post-dummy into different years, and we find that before the event, there's no significant impact, but after the event, in the first year after the chemical spills, there's no impact, but the impact into all the funds adjusted their portfolio in the second year after the chemical spills. So it suggests that it takes about 1 to 2 quarters for fund managers to rebalance their portfolios after they are aware of these chemical spills. And we also separated the different pillars. We find that treated funds invest in stocks with only the high E and S scores, while the G scores are not relevant. And this is consistent with the previous literature and also consistent with our setting, because chemical spills are related to the human cause, so about S, and also related to the environmental issue, so that's about E. Nothing about G. And we tested several heterogeneity in the fund response, and we find that first we use the calculate the proportion of votes to the Democratic Party in the president election in each election year, and we find that the interaction, and then we interact this variable into the DID regressor. We find that the coefficient is significantly positive. So this means that the funds increase more into high ESG stocks when they located in the Democratic leaning counties. So this is consistent with the expectation because that Democrat supports the environment issues more than the Republicans. And next, we use several variables represent the public belief of the environment issues. That is from the survey data. So that survey represents the what's the proportion in each county when the people think that the climate change, environmental issues will affect a human in like 10 years after, and whether they think
You have 1 minute only.
Okay, yeah, I will speak up. Anyways, these are the measures for the public belief of the environment issues. We find that treatment effect is stronger in funds located in the counties with higher public concerns on the environment issues. Okay, and let me skip these findings, and I will, because I have something to tell about the robust check. We use several clustering, and the results are the same. And we also exclude the funds located in the same county as a chemical spill, because we focus on the we focus on the funds response after they hear about or be aware of the chemical spills. So we exclude the funds that are directly impacted by the chemical spills. And we also exclude the stocks that located in the same DMA or county as the event, right? Because there could be some impact of the chemical spills onto the fund level characteristics. So this will confound because we focus on the fund actions. So we exclude these stocks, and the results are the same. And we also use the PSM, and we reevaluate the treatment effect using the staggered DID. All the results are consistent. Okay, so let me, because of timing, let me skip these two results and jump to the conclusion. So we find that the impact, we document a positive impact of salient chemical spills on fund managers' decision regarding the ESG investment. And we find that they reallocate their investment from the low ESG stocks into the high ESG stocks, but they only invest or they only increase the existing high ESG firms. They do not buy new shares of the green firms. Okay, so this is all about my presentation, and thanks.
Thank you very much.